And the South African Reserve Bank has cut the repo rate by 25 basis points, taking the policy rate to 7%. This is the third cut this year and the bank's longest easing cycle since 2019. Mpho Molopyane, Executive Chief Economist at Alexforbes and Isaac Matshego, Economist at Nedbank, joined Dowling to unpack the decision.
Quite explicit, right? So, explicitly saying that we prefer inflation expectations to be anchored at 3%. And this is pretty much in line with, the change in statement that we saw when they initially moved to 4.5, right?
Yes.
Same messaging. And immediately it was, the target is now 4.5. We want inflation expectations to be anchored there. They're not saying that the target is 3% because their official statement has to come from the National Treasury.
Yes.
But how they're getting around that, they're saying that, this is what we prefer. The target is 3 to 6%. So we're still within our mandate, but we just prefer that inflation expectations be anchored at the lower end of the target. The governor also saying that, inflation is already at 3%. We were, just talking that, inflation is at 3%, haven't been lower over the past 3 months before it crept up to 3%. So the governor is saying that, inflation is already at 3%. Let's lock in these gains and lock in inflation at 3%. And lastly, what I also found quite intriguing as well is if you look at the forecast table that they give. So, usually previously they've been giving, the main forecast and then they've been giving scenario on the side. Immediately when I went to the website, I was like, okay, I was a bit confused. Where's the 3% scenario? Then I opened the main document. And for me, what was quite striking was that the inflation for the forecast are the 3% baseline essentially, and in brackets it's the 4.5%. If the target was still 4.5, you would expect the scenario to be the scenario numbers to be in brackets. So in the sub is telling us that while they're waiting for an official announcement from the National Treasury, they have moved on. They are on the 3% bus now.
And I mean, Isaac, Sub-Governor Lesetja Kganyago has mentioned that they don't need Treasury to support them, but they would like the support, right? Talk to me about then whether this creates some sort of confusion, because here we are not knowing whether we are using the 3 to 6% target, whether we're still using the 4.5% target without a concrete communication. I mean, markets, yes, have, priced in that announcement, the 3% target announcement will come in this year. But at this point, does this not create some sort of confusion?
Well, I will say that, profound that the announcement is, we should actually accept it.
Yeah.
We should know that officially or unofficially, but I believe more officially from today, the target is 3%, because I don't believe that the governor would have made such an announcement without the confidence of being backed by the National Treasury. I can say that we're just waiting for the official announcement in the MTBPS in the third week of October. So 3% is the number. Paul has highlighted that in their forecast now, looking at the tables, they're just working around 3%. Look at the predicted increases in the unit labor costs, 2.7% a year by 2027. That says to you that the Reserve Bank is quite confident that, this number will stay. There will be buy-in from probably all sectors of society. Now it's all about, watching the inflation expectations, and they should be anchored lower to 3%, moving away from 4.5.
And perhaps let's take back, right? The conversation, the debate around lowering inflation, the inflation target has sparked, a lot of criticism, some supporting, some criticizing the move. There's been conversations around short-term pain for long-term gains. Let's perhaps remind the viewers what this means and how it will impact the regular South African citizen, Mpho.
Yeah, so I mean, what's quite interesting as well, and this has definitely been discussions that we've been having with our own clients, that we've been saying that should the SARB move to a low inflation target, that means that monetary policy may need to be kept tight
Yes.
in order for them to reach that 3% target. But we've also been quite explicit to say that tight monetary policy does not necessarily mean that the SARB is going to have to hike policy rates. No, it certainly does not mean that, because something that we haven't spoken about now, but we did talk about it previously, that if you look at the real rate, so if you take your nominal repo rate at 7%, and then your inflation is at 3%, right? That gives you a real rate of just up just around 4%. And what that means is that it is significantly higher than the SARB own estimate of the neutral rate, which is around 2.8%, right? And that neutral rate is the rate at which monetary policy is neither restrictive nor tight.
Yes.
So at the level where the real rate is, it's already tight, and that will be sufficient for the SARB to be able to, move inflation expectations to this 3% that they're now targeting. But what it means is that from a growth perspective, because monetary policy is tight, from a growth perspective, it means that growth will be lower versus if monetary policy was not tight, right? So like what I found quite interesting as well is that if you look at their growth projections, right, and they do give us what growth would be in the 3% scenario and in the 4% scenario, and you see it here that in the 3% scenario, growth is projected at around 0.9% versus 1%, right?
Yes.
And then next year, growth is projected at around 1.3% in the 3% scenario versus 1.5% if we were in the 4.5% scenario. So that's the cost from the growth side, because monetary policy is tight. Otherwise, they should be cutting a lot more and to reduce the level of restrictedness, but they're not, because they're now in this 3% scenario. So from a consumer perspective, it does not mean the SARB is going to be hiking. I mean, and also that is, in economics, forecasting is hard, but we always say, should things stay the same, in the absence of shocks and in the absence of surprises, the SARB shouldn't be hiking, and they would still be able to get to the 3% scenario without having to hike, essentially.
And you touched on growth, and I guess that's going to be my next question for you then, Isaac. We saw that growth for 2025 has been downgraded, but risks remain balanced for both 2026 and 2027. Of course, they've also highlighted what growth will look like with that 3% scenario. The SARB seems quite positive about growth going into 2026, 2027. I just want to ask you, are they not too positive? It seems like they are also pegging it on structural reforms, right? And just looking at the pace at which Transnet is turning around, which has been quite slow. Transnet has also been in the headlines. What's this? Not Treasury, it was the Department of Transport recently approving even more guarantees for the state-owned firm.
I will say that for South Africa, any growth number, annual growth number below 3% cannot be too positive.
Yeah.
We're still in that rut. We really need to boost this economy. We need to get those reforms really going under operation. Volintela and sorting out, the key SOEs and stimulating fixed investment spending, particularly by the private sector, to complement the planned investment by the public sector. So not too exciting on the growth front, but really what got me interested in this statement is Mpho has been talking about that, the lower target doesn't necessarily mean that interest rates are going to increase. Actually,
yes.
in the statement, the MPC makes it clear that, if we are going back to the 4.5% target, i.e. we're going to tolerate inflation at 4.5, no more cuts. 7% is sort of the bottom in the cycle. But if we embrace the 3%, the governor mentioned about 5 cuts.
Yes.
I would be quite glad to see that happening in South Africa, because, that's an environment that will really boost us.
And just on the back of that, and talking about those cuts in this 3% target environment, do you then expect those cuts to come in on a longer term basis? So perhaps are we at the end of the cutting cycle for 2025?
That's what we got to wonder about. And of course, the Reserve Bank is not going to give us any indication. We can look at the QPM model.
Yeah.
But, if we get those cuts within the next 2-3 years, I'd be very happy. We'd all be happy, I suppose. Being a banker, I'd definitely be happy.
Listen, from a consumer's perspective, I'll also be happy. I'm crossing my fingers, I'm crossing my toes. Everything that can be crossed is being crossed. Mpho, what about you? Are you of the expectation that we are done when it comes to rate cuts for 2025?
Yeah, I mean, I'm in the, if we are now adopting the 3% scenario, which seems to be the case now, right? Then we're not expecting any cuts. We've also been running our own numbers in terms of, what inflation is likely to look like and what that means for the repo rate. And our view has been that, should we move to a 3% scenario, then
we seem to
cut.
Okay.
And from here on, the next time that window of opportunity will open only by the end of 2027. And this is premised on, going back to the SARB's inflation forecast. They are quite optimistic around how quickly inflation expectations are going to adjust. And it was actually a question which was asked during Q&A to say that, when you move to 4.5, it took about 4 years for inflation expectations to adjust lower. Why are you all of a sudden being, overly optimistic about how quickly inflation expectations are going to adjust? So we certainly in that camp that we think that inflation expectations are going to adjust more gradually. So the SARB only reaches the 3% target, by the end of 2027, and hence the easing cycle resumes then again. So for now, we're not expecting any further cuts in this environment.
That was Isaac Matshego, economist at Nedbank, and Mpho Molopyane, executive chief economist at Alexforbes.